Hi, it's the Tax Geek again with more oversimplified information about your taxes. Today we ask the question, can I qualify for an earned income credit? The Earned Income Tax Credit is arguably the most important part of the tax law affecting low to moderate income wage earners. It can provide needed financial assistance to these taxpayers and their families. Over $50 billion in earned income credits are distributed to low to moderate income families each year, making it the third largest social welfare program in the United States after Medicaid and the food stamp program. The idea of what would become the earned income credit had its roots in the early 1970s when the idea of a guaranteed national income was proposed in the form of a negative income tax. Eventually, a tax credit to working individuals and families was proposed, and the first earned income credit was enacted in 1975. The original maximum credit was just $400, but as time went on, the credit was raised and expanded to what we see today. Although millions of Americans receive earned income credits, many more are eligible for the credit and don't claim it. The IRS estimates that as much as $7.3 billion in earned income credit is left on the table by eligible taxpayers. And incomes don't have to be particularly low to receive it. In fact, for a married couple with 3 children, the eligible income to receive the credit can be as much as $56,844. For each class of taxpayer, the credit starts out low, then rises rapidly to a plateau in the middle of the eligibility range. The credit then diminishes as income rises. The credit is refundable, which means you receive it even if you have little or no tax liability. The credit is treated as a payment against your taxes, much like your withholding. So enough about what the credit is. Who is eligible to receive the credit? To receive the credit, there are 4 musts and 5 must-nots. Let's start with the 4 musts. Must number 1, you must have earned income. Earned income is primarily your income from wages and self-employment. Members of the armed forces deployed to a combat zone may include their non-taxable combat pay if it gives them better results. Must number 2, you must be a U.S. citizen or permanent resident for the entire year. Must number 3, you must have a Social Security number that is valid for employment, and must number 4, you must have lived in the United States for at least half the year. Now, let's look at the 5 must-nots. Must-not number 1, you must not be married and file a return separately from your spouse. Must-not number 2, you must not have foreign earned income subject to exclusion from tax. This type of income is reported on Form 2555. Must-not number 3, you must not have investment income over $3,650. Investment income includes interest, dividends, capital gains, rental or royalty income, or passive income in the form of certain partnership or corporation income. Other types of earned income aren't subject to the limit, though they will affect the amount of the credit and may make you exceed the eligibility maximums. Must not number 4, you must not be the dependent of or the qualifying child of another taxpayer, and must not number 5, you must not have earned income or adjusted gross income over the maximum eligible incomes. Here are the maximum incomes to qualify for the Earned Income Credit. Please keep in mind that these are as of 2020 and increase every year with inflation. And here are the maximum credits you can actually receive. To be eligible for the Earned Income Credit without a qualifying child, in addition to the requirements and limitations already mentioned, you and your spouse, if married, must be between the ages of 24 and 65. To claim a qualified child, the child must meet the same qualified child rules used in claiming a dependent. To be as brief as possible, a qualified child must be your child, stepchild, or foster child, a sibling that is younger than you, or any of their descendants. Must be under the age of either 19, 24 if a full-time student, or any age if permanently and totally disabled. Must live with you for at least half the year, generally not file a joint return with a spouse, and must not provide over 50% of his or her own support. Children who qualify you for an earned income credit must be listed on a Schedule EIC that is included with the tax return. The credit itself is calculated using a worksheet that is kept with your records. Here is an extremely simplified explanation as to how the earned income credit is calculated. The credit amount is looked up in the earned income credit table for both your earned income and your adjusted gross income. Your earned income credit is the lower of these two amounts. Tax preparation software will compute your earned income credit properly, assuming all income and dependent information is entered correctly. Professional tax preparers must also complete Form 8867 for every client who receives an earned income credit, verifying the taxpayer is legally entitled to claim it or face a potential fine of $530. Phew! I did not think I could describe the earned income credit in less than 1,000 words. Needless to say, I had to leave out a lot of details, but these are the rules that apply to most taxpayers. There are links in the description for more detailed rules. There are also links in the description for deeper dives into several concepts of what goes into qualifying for and computing this credit. If you found this video informative, please give it a thumbs up and subscribe for more content. If you have any questions, comments, or suggestions for future videos, please leave them in the comments space below. Thanks for watching and stay tuned for more of Your Taxes Oversimplified.